Now, there's going to be a few different variants to this model, but this is the simplest one, and I'm going to go over it real quick. The market should create a pool of liquidity by making a high and trading lower. Making a low and form liquidity below it. So above an old high is buy side. Below an old low is sell side. We want to see a run above it when we're bullish. Take that buy side in first. So now traders that would be looking to go long on a breakout, they are in. Their stop loss would naturally go down here, or something inside this range. Either way, the market trades that low, takes out the sell side. So anyone that's long here, they get stopped out. Then the real move comes at a time of day that's key, between 7 o'clock in the morning Eastern Standard Time to 11 o'clock in the morning. That's his working hours. And then I gave you 7 o'clock, 8 o'clock, and 9 o'clock. Using those intervals, the first 30 minutes of each one of those hours, he's looking for this type of framework. So if we get a rally up and it drops back down into a fair value gap at a time that's key, as I just mentioned here and in previous lectures that I've done in the 2024 mentorship, this would be where he would look to go long. That means he's trying to buy. He would use an entry price at the high of the fair value gap plus 1 tick. His stop loss would be at this low or 1 tick below it. The stop loss moves to cover the costs, that's commission, and any risk once it moves from this high to the first partial. The first partial and the target, I'll outline that in a moment, but for now, this is where you would think to move the stop loss once price trades to it there. You may get stopped out. It's okay. You're trying to protect yourself. The first thing you're trying to use is the shield, not the sword. Partial will be taken when it gets to a Fibonacci extension. In this case here, partial number 1 would be a swing projection coupled with a new day opening gap and or new week opening gap lowest level. So whichever is the lowest in close proximity to that Fibonacci extension, that's what you're going to be using for your first partial. And your terminus would be, again, some Fibonacci extension that overlaps with a new day opening gap and or new week opening gap lowest level. That means it's low. All right, so this is what it looks like in a candlestick formation. So in actual price, you'd see the high here, a low here. Buy stops are triggered. Longs are triggered in if they're looking to break into a new breakout run. Their stop loss would be in any one of these lows here, and as much as that low down here, we would like to see price go down there. It does that. So we had a buy stop raid, sell stop raid. Buyers are tripped in, buyers are stopped out. Short sellers are tripped in. Naturally, their stop would be here, but the move is going to be going higher when we're bullish, so that just takes care of them handily anyway. At 9:30, we have the opening bell, rallies up, comes back down, creates a fair value gap, rallies, takes it into half of the move between this high here and the first partial. I have the Fibonacci extensions, this low to that high, negative 0.5 gives us this level. It just so happens that that's very close to new day opening gap low. So you would use that as your first partial. Once it gets halfway between the high and your first partial, your stop loss would roll to cover costs. Here's where you can see your sell stop will be at that candle's low, minus 1 tick. The inefficiency candle below that low is where your long initial sell stop goes. Buy limit is 1 tick above the fair value gap high. So as it drops down, you'll have a little bit of drawdown. Your stop loss is here. You may get stopped out. It's fine. If you do, you stop for the day. You go in the next day looking for the same type of setup. You're going to reverse everything that's shown here when you're bearish. As price runs up into half of the range between the high and the first partial, sell stop rolls from here above your entry that would cover the costs and remove any risk. So if it comes back down and stops you out, that's fine. Once partials are taken, you leave the stop. You don't move it again and wait for your terminus. Terminus would be a swing projection that's coupled with, again, new day opening gap and or new week opening gap. So that would be here. Even though a fib might be up here, you're going to take the lowest hanging fruit objective. So as soon as it hits the new day opening gap or new week opening gap that's closest to the fib. You're not trying to be perfect. You're just trying to slide into home, and then hopefully the momentum will carry you into it. And you may get a stellar exit. So sometimes the fibs don't actually get traded to. And again, sometimes the higher order of the new week opening gap or new day opening gaps don't get traded to either. And here's what it looks like with the sell stop rolled higher. And again, the opening range is 9:30 to 10 o'clock. And that would be just one variant. It could be 8 to 8:30 where it forms, or it could be 7 to 7:30 where it forms, or any time between 7 o'clock and 9:30. But you close your charts at 11 o'clock and you're done. If there's no trade, just stop.